Today, a soft landing, perhaps. Hello again, it's Martin North from Digital Finance Analytics. Well, latest posts covering finance and problem news with a distinctively Australian flavour. In our weekly market update, we start in the US, go across to Europe and Asia, and end in Australia. Now, here's a question for you. Is it possible for the US and other industrialized countries to bring inflation down without triggering huge jumps in unemployment that economists would otherwise have predicted prior to the pandemic? Well, maybe, according to new research from the Federal Reserve Bank of Chicago. The research examines the Phillips curve. That's a measure of the inverse relationship between inflation and unemployment for 29 countries in the 7 years before COVID-19 and the 6 quarters of pandemic recovery, for which there is data beginning in January 2021. The authors found that in each country, including the US, the curve steepened, meaning that the decline in inflation is leading to a smaller increase in unemployment than it did before the public health crisis. While the authors caution that their analysis is limited, there is only a year and a half's worth of recovery data examined, for example, their conclusions do bolster hopes that Fed rate hikes can curb high inflation without causing millions of Americans to lose their jobs. Now, if that's correct, that might improve the chances of seeing a unicorn-like soft landing for the US economy. Kansas City Fed President Esther George said the US central bank doesn't want to raise interest rates by so much that policy becomes overly restrictive, and agrees that the economy may avoid a sharp downturn. This scenario can be that there is a soft landing. That's one we'd all want to see, George said. There are some possibilities for that. And she went on to say, we're reaching a point, I think, where it will be important to start looking around corners. Anyway, US stocks rallied to close higher on Friday as the S&P 500 and Dow snapped a 3-session losing streak, and the Nasdaq rose more than 2% as quarterly earnings helped lift Netflix, while Google parent Alphabet climbed after announcing job cuts. The Dow Jones Industrial Average rose 1% to 33,375. The S&P 500 gained 1.89% to 3,972, and the Nasdaq Composite added 2.66% to 11,140. For the week, the Dow lost 2.7%, the S&P 500 shed 0.66%, and the Nasdaq gained 0.55%. The weekly loss in the broader market comes after data earlier this week, including weaker retail sales, flagged recession concerns at a time when many worry that the Fed may overshoot on policy tightening and so tipping the economy into recession. Shares of Netflix jumped 8.46% as the streaming company added more subscribers than expected in the fourth quarter, and said co-founder Reed Hastings was stepping down as chief executive. The important takeaway is that the new ad-supported tier resulted in retention of subscribers, Webbush said in the note following Netflix's results. We expect this phenomenon to repeat itself in the coming year, with the result that we expect Netflix to return to subscriber growth of 17 million new users per year. Despite growing belief in that soft landing, Silicon Valley CEOs are taking no chances and are instead firing their workers by the tens of thousands. Google joined the crowd on Friday as its parent company Alphabet terminated 12,000 people, or more than 6% of its global workforce, becoming the latest tech giant to retrench after years of abundant growth. In the wave of tech workers culling, some 100,000 people have lost their jobs so far. Alphabet was the most recent company to announce job cuts, as it said it was cutting 12,000 jobs, sending shares 5.34% higher to 98.02. The gains sent the Communication Services Index up 3.96% as the top performer among the 11 major S&P 500 sectors, notching its biggest daily percentage gains since November the 30th. High-growth sectors, such as communication services, were among the worst performing in 2022 and were notably weaker in the last few months of the year as investors gravitated towards stocks with high dividend yields. Today's action is probably because we had 3 down days, so it got into a bit of an oversold position, and they are just doing a little bit of bargain hunting today, said Ken Polcari, managing partner at Case Capital Advisors. If people are viewing an opportunity, if they are getting more comfortable with the Fed's narrative, investors are starting to buy into that narrative and saying, okay, that is the way it is. Let's look at the stocks that got really beaten up because the market is a discounting mechanism. These short-term developments suggest investors are rotating away from the defensives and that a risk-on bias can continue to return even as we move through earnings season and the threat of recession weighs on investors, said January Montgomery Scott. Comments from Federal Reserve officials have largely said they expect interest rates to climb to at least 5% this year as the central bank continues to try to tamp down high inflation. On Friday, Fed Governor Christopher Waller said the central bank may be pretty close to a point where rates are sufficiently restrictive to cool inflation, which gave an additional boost to equities. The Fed is largely expected to raise rates by 25 basis points at its February 1 policy announcement. Still, concerns about corporate earnings persist as the US economy shows signs of a slowdown and a possible recession. Analysts now expect year-over-year earnings from S&P 500 companies to decline 2.9% for the fourth quarter, according to recent data, compared with a 1.6% decline at the beginning of the year. Gains on the Dow were curbed, however, by a 2.54% fall in shares of Goldman Sachs, after the Wall Street Journal reported the Fed was probing the company's consumer business. The yield on the US 10-year note leapt 9 basis points to 3.48%, in sync with similar moves elsewhere. In the UK, the 10-year yield there was 10 basis points higher to 3.3885%. Part of the overall optimism in sentiment was driven by rising expectations that the Federal Reserve will downshift when policymakers announce their next decision 1st of February. TD Securities said it has revised its forecast to a 0.25% rise from a 0.5%. It still expects a further 0.25% increase in both March and May, though the tweak points to a lower peak. In addition, TD said it was pushing forward its forecast for a pivot to rate cuts to March 2024 from December 2023. The final Fed policymaker to speak ahead of the January 31, February 1 meeting was Governor Christopher Waller. I currently favour a 25 basis point increase at the FOMC's next meeting at the end of the month, Waller said in remarks prepared for delivery at the Council on Foreign Relations in New York. Beyond that, we still have a considerable way to go toward our 2% inflation goal, and I expect to support continued tightening of monetary policy. So here's what LPL Financial Chief Technical Strategist Adam Turnquist said: buying pressure at high lows, bullish momentum, and broadening participation in the recovery should continue to support the current drive off the October lows. Falling and or stabilising interest rates, a weaker US dollar, and the potential end of the Federal Reserve's rate hike cycle also provides a more constructive backdrop for the development of a market bottom. Of course, disappointing earnings, sticky inflation, and increased recession risk could bring the defence back on the field. But for now, we suspect a first down for the S&P 500 is likely over the coming weeks, defined by a close above 4,000. That would normally break the current downtrend resistance line and recapture the 200-day moving average. A close above the December highs at 4,100 would then confirm a new uptrend is underway. European shares closed higher on Friday but marked weekly losses as investors took a cautious view of the earnings season and the upcoming central bank decisions, although China's reopening from COVID-19 lockdowns offered some relief. The DAX index in Germany closed 0.76% higher to 15,033. The CAC 40 in France rose 0.63% to 6,995. And the FTSE in the UK climbed 0.3% to 7,770. European stocks have had a strong start to the year, actually, with the German DAX up over 7% year to date, helped by hopes that the expected economic slowdown in 2023 would not be as severe as previously feared, as well as optimism surrounding a recovery in China, a major export market for European companies, from COVID restrictions. Helping the tone on Friday was a fall in Germany's producer price index for the third straight month in December, down by 0.4% on the month. On an annual basis, producer prices for industrial products in Europe's largest economy were up 21.6%, but down from 28.2% in the previous month. That was actually the lowest yearly reading since November 2021. Less positive, though, was the fall in UK retail sales by 1% on the month in December, and that was an annual drop of 5.8% as the monetary tightening and the cost of living crisis weighed on discretionary spending. However, gains remain tenuous, with European Central Bank President Christine Lagarde warning at the World Economic Forum in Davos, Switzerland, on Thursday that inflation figures remained way too high in the region, reiterating the need for aggressive monetary policy decisions. Investors will closely monitor further commentary from Christine Lagarde after the ECB president and fellow policymaker Klaus Knott said investors were underestimating the central bank's determination to bring inflation back to its 2% target. While the Federal Reserve is widely now expected to hike interest rates by just 25 basis points at its next policy meeting in February, the ECB is still looking to hike by 50 basis points. The Pan-European Stock 600 rose 0.4%, lifted by travel and leisure and retail stocks. And Spain's Celnex jumped 9.8% after a media report said that American tower and asset manager Brookfield were weighing a possible takeover bid for the mobile phone tower operator. However, the benchmark Stock 600 posted weekly losses of 0.1% despite hitting a 9-month high earlier in the week, weighed by disappointing earnings reports, weak US economic data, and hawkish comments from central bankers. We've seen this robust value in European stocks largely underpinned by three factors: better than expected economic outlook given the milder winter conditions in Europe, China reopening, and signs of peaking inflation, said Laura Cooper, a senior investment strategist at BlackRock. But if you take a step back, from a policymaker's perspective, they are still in a position to continue to raise rates as inflation remains uncomfortably high. We still remain cautious on European equities, and it is about taking a selective approach. China-exposed luxury goods such as LVMH and Hermes International rose about 0.8% each. China said the worst was over for its battle against COVID-19 ahead of what is expected to be one of the busiest days of travel in years on Friday, a mass movement of people that has fed fears of a further surge in infections. Europe has more exposure to China reopening, and luxury is a big part of the European market, said Jamie Mills O'Brien, investment manager at ABRDN. Some of the big players are pure China reopening bets. On earnings-driven moves, Denmark's Ørsted, the world's #1 offshore wind farm developer, tumbled 8.7% after announcing a write-down on a large US offshore wind project and an earnings forecast for 2023 that fell short of analyst estimates. Ericsson slid 4.7% after it reported lower than expected fourth quarter core earnings as sales of 5G equipment slowed in high-margin markets such as the US. And on the flip side, SSC stocks rose 2% after the UK-based power generator raised its profit guidance thanks to a year of record high wholesale energy prices. Oil prices rose on Friday for a second straight positive week on continued optimism that the brightening outlook for the Chinese economy will result in increased demand from the world's largest crude importer. This week, in their monthly report, both the OPEC and the International Energy Agency forecast that a Chinese economic recovery would spur record high crude demand in 2023. And that confidence has helped the market look past data showing a bigger than expected build in US inventories after the Energy Information Administration reported an increase of over 8 million barrels on Thursday. US crude futures traded 1.37% higher to 81.72 on Friday, while the Brent contract rose 1.74% to 87.66. Both closed 1% higher on Thursday, near their highest closing levels since the start of December. Additionally, gold futures rose 0.2% to $1,927 an ounce, while the euro-US dollar traded 0.27% higher at 1.0856. Most Asian stock markets rose on Friday and were set for a strong weekly performance amid growing optimism over a Chinese economic recovery this year, although fears of a potential global recession kept gains constrained. China's Shanghai Composite Index rose 0.76%, with markets positioning for a major economic boost from the week-long Lunar New Year holiday, especially after the country relaxed most anti-COVID restrictions. The indices added over 2% for the week, their fourth straight week of gains. Hong Kong's Hang Seng Index was the best performer for the day, rising 1.82%, and that was a weekly gain of 0.7%. Chinese stocks have been on a tear since December as traders bought into heavily discounted stocks on the prospect of a major economic recovery this year. Gains in local stock markets have persisted even as the country faces its worst yet COVID-19 outbreak. The Chinese government is also doling out more spending measures to shore up growth. The People's Bank of China kept its benchmark loan prime rate at historic lows on Friday, keeping liquidity conditions flush for a fifth straight month as it moved to support local growth. Broader Asian stock markets also rose on Friday, with Japan's Nikkei 225 index rising 0.56%, even as data showed consumer price inflation rose to a 41-year high in December. The Nikkei added around 1.5% this week after the Bank of Japan bucked market expectations for more tightening in its monetary policy, pointing to accommodative conditions for local stocks. But markets are now speculating whether rising inflation in the country will push the BOJ into eventually hiking interest rates from record lows. South Korea's Kospi index rose 0.63%. The ASX 200 climbed 0.23% to 7,452 on Friday, lifting its weekly gain to 1.7% and knocking on a 9-month high. Bumper quarterly updates by Whitehaven Coal and Pilbara Minerals boosted the Australian share market on Friday, lifting the benchmark index to its highest close since April. Whitehaven Coal jumped 6.2% to $9.48 after forecasting its first half earnings to quadruple to $2.6 billion compared with a year ago, buoyed by record high coal prices. New Hope Corporation firmed 2.7% to $6.76, and Stanmore Resources rose 4.6% to $3.66. Pilbara Minerals, meantime, rallied 13.2% to $4.55 after its day-earlier quarterly update. Macquarie said the lithium miner beat its production forecast by 16% and its shipment forecast by 4% and kept its outperform rating on the stock. Lithium producer Liontown Resources plunged 8.3% though to $1.37 after warning that higher costs at its Kathleen Valley site will take spending to first production from the process plan to $895 million. Perpetual suffered net outflows of $1.2 billion in October to December, but the company managed to avoid ending the year with a loss in assets under management. The fund manager had total assets under management across its global businesses of $93.7 billion at December the 31st, up 4% on the year earlier. The stock, though, fell 0.8% to $26.20. Retailer City Chic Collective said it expects to post a loss between $2.5 million and $4 million in the 26 weeks ended January the 1st. The stock dropped 7.7% to 66 cents. The major miners posted modest gains as iron ore futures in Singapore firmed 1.5% to $123.08 per tonne. BHP rose 0.5% to $49.95, and Rio added 1% to $127.20, and Fortescue Metals Group edged 0.1% higher to $22.60. Finally, crypto lender Genesis finally bowed to the inevitable and filed bankruptcy 2 months after it was forced to suspend client withdrawals due to a massive loss on its exposure to FTX. The move effectively puts a court in charge of the biggest fight going on in crypto land right now between the Winklevoss twins and Barry Silbert's digital currency group, Genesis's ultimate owner. It will have to decide which of Genesis' creditors will get paid first and who, if anyone, will make whole over 340,000 customers of the Winklevoss investment platform Gemini. Both Gemini and Genesis have been charged by the Securities and Exchanges Commission with illegally offering securities in the US, and both the SEC investigation and the bankruptcy process raises the spectre of a largely forced liquidation of some of the world's largest holdings of crypto assets. According to its filing, Genesis owes its 50 biggest creditors some $3.8 billion, a little more than anecdotal reports had suggested earlier. But that said, Bitcoin was significantly higher, up to 22,545. That's up 6.91%, while Ether was up 6.09% for 1,648.40. So amidst all the turmoil, could it be a soft landing is in the air? Well, I think it's too soon to know, but it will be interesting to see how the Federal Reserve reacts when it lifts rates later on in the month, into early February. And particularly watching the ECB. I think the ECB is one to watch because, to my mind, that is where a lot of the cracks are showing at the moment. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.